Good morning, everyone, and welcome to our EEX webinar on Cal+10 and the future of renewable energy risk management. My name is Viviana Ciancibello, and I'll be your speaker today for EEX, and I'm thrilled to be joined by Dr. Arne Weber, Head of Origination at Aquila Capital, who'll be discussing a bit more from the perspective of the market on this very exciting topic. So for today, we'll start off with just a little overview from my side on our recent product launch of 10-year futures, and a bit about the background on why this can be beneficial or why it's being integrated into the risk management framework of EEX clients. And then we will hear from Arne from his perspective, and he'll give a brief presentation as well. Then we'll have a bit of a discussion on, especially to get Arne's views on, for example, some recent market developments and how this is impacting PPAs. And then finally, we'll have a Q&A session where we'll be happy to answer your questions, which you are welcome to put into the Q&A chat box during our talk. So, Cal+10. As some of you may know, EEX recently extended their base load yearly futures to 10 years ahead on the 27th of September this year. This has been mainly driven by the risk management needs of long-term power purchase agreements, or PPAs. And we have extended this to 10 years in Spain, Germany, and Italy, to facilitate more long-term hedging in those markets that have particularly high PPA demand, or for example, in Germany, where we have our benchmark liquid contract for the power markets in Europe. And what you see here is actually our standard product setup for EEX futures, where we list maturities starting from the short term. So for example, the days, the weekends, the weeks, and going into medium and longer term months, quarters, and years. So while the standard product setup at EEX for 20 different power market areas is currently mainly at 6 years ahead, now in those 3 areas, Spain, Germany, and Italy, you can hedge for up to 10 years ahead. The 10-year futures have been listed on the base load contracts, which of course represents 24-hour generation. But of course, we do also list peak load contracts as well for all market areas, except for a few. So how are EEX members active in PPAs? A lot of EEX members play a pivotal and central role in facilitating the development of new renewable energy assets. And they are mainly represented here in the center of this diagram. So EEX members, and we are primarily talking about here utilities, buy power on long-term contracts like PPAs from renewable energy developers who are here represented on the left. They can also build their own renewable energy assets and sell those on as well through long-term contracts. Importantly, as well, EEX members are very well integrated into the wholesale markets, both on the short-term spot side and on the long-term future side. So they already have the internal resources and capabilities to manage their risks on the short-term optimization, physical flows, and long-term hedging through risk management, futures trading, and so on. Of course, in the bottom here, we have 2 other major players in PPAs. First are the banks, which provide, of course, the financing to these projects, usually once a PPA is already in place. And we have the corporates, which of course we've heard of a lot of in the past couple of years in terms of corporate PPAs, who have risen as a new class of buyers in long-term agreements and who are driven primarily by the desire and the demand to fund, to kind of have 100% renewable energy generation for their operations. So who are the PPA hedgers on EEX? So breaking down the fact that we have a lot of EEX members in PPAs, this just divides them into further subcategories. So first and foremost, we have the utilities, as I mentioned. These are usually large, multinational European utilities who are active in many markets and throughout the value chain. They have established and well-functioning trading operations on the front office, back office side, origination, and so on. And so they are very well positioned to both handle the generation side and the risk management side. We also actually have quite a few industrials who are active as PPA hedgers, primarily oil companies, for example, who are pivoting to renewable energy generation or who are also buying renewable energy for their operations. Excitingly, we've also seen a few renewable energy producers or developers join the exchange directly recently. The best example of this, for example, is Sonadix, and actually Aquila has also joined recently as well. So excited to hear a bit more about that from Arne. But this is what we see as a new category of EEX members who are purely renewable energy generators and are hedging their generation on the derivatives markets. Finally, we have intermediaries. So these are mainly banks who are providing intermediary services to renewable energy developers. So this means they are providing them with market access to EEX. So those developers don't have to become direct exchange members themselves. And they may also provide other hedging services. EEX clients, such as utilities, and for example, also provide client services to developers and other smaller, medium-sized businesses where it may not make as much sense for them to join the exchange directly. And it is also a valuable way for them to effectively outsource some of their risk management to an operation such as a utility. So, as I mentioned, EEX lists power derivatives mainly for baseload and peak load profiles. But as I'm sure you're aware, renewable energy profiles, especially wind and solar, do not look like a baseload profile. So how is this gap bridged, and how are baseload products actually used in an effective way as a means of risk management? It all comes down to a few principles of why exchange trading is beneficial. First of all, exchange traded products are a best fit product. So what we try to do is attract the most liquidity from the most players with a product that suits, say, the majority of their risk management needs. So for using the baseload products to manage the risk of a wind or solar asset, you would need to devise a hedging strategy and figure out from your portfolio the best price and volume to trade at on the baseload products and kind of translate the wind or solar profile into that position, as it were. And this can be done in a variety of different ways, but it's usually the job of the risk management professional in the organization to perform this function and then pass this on to the trading desk to be able to perform the trades. So, long-term hedging on EEX. This has actually been a trend for several years now, and it actually started in May 2018, particularly in Spain. Spain, of course, is the market with the most PPA activity in Europe so far, primarily because the Spanish government stopped giving subsidies to new renewable energy projects already for several years now. So this is where we have seen the most merchant projects as well, which of course has become another big buzzword throughout Europe as more and more subsidy schemes are expiring. So in Spain, we have actually had 48 long-term hedges, which have been registered OTC. That means they've been bilaterally negotiated. And this has reached a total volume of 18 terawatt hours. And to give you an idea of the size of that, it's equivalent to about 3% of the electricity consumption in Germany. So quite a sizable number. We've also seen activity registered in Italian power, just a few deals there, but we do expect that market to grow in the coming years as, for example, the cost for solar projects become more competitive. There are a few other caveats there in the Italian market. I believe we also need to see a little more support on the policy side to support PPAs, but it is a market that we believe will have hopefully more growth in the coming years. Another interesting example of a long-term hedge was actually in Polish power. And this was particularly interesting because EEX does not actually have yet an extremely well-established liquidity position in Polish power like we do in other markets. It is growing. And so this deal really proves the value that derivatives hedging can bring to these multinational utilities in particular, who perhaps have hedged already long-term in other markets and want to create that same value in the Polish market or in another market, for example. So this was really quite interesting. It also shows the trust that these companies place in our clearinghouse, the ECC, to manage the risk of these contracts and guarantee the execution. Finally, long-term hedging in German power is still growing, but we do expect this to continue or hopefully become a bit more prominent as EEG subsidies also expire. And for example, we see the hedging of end-of-life assets. So now that we have extended to Cal+10 in Germany, Italy, and Spain, what we have also done is created more price transparency in these markets because we are publishing a daily settlement price for all three markets out to 10 years ahead. So this is really providing a value add to the PPA market as well, as market participants can look towards these prices and see where the wholesale market traders view the 10-year curve and take that into consideration when they are valuing their renewable energy assets. Of course, when you're hedging to 10 years ahead, the primary benefits are price risk hedging and counterparty risk management by the ECC as well. So just to quickly go through a few examples of long-term hedges and exactly what we mean by this. This is a snapshot of one deal that was registered earlier in the year in Spain. And what happens is that these deals are registered as a strip of trades, which means trades registered all at the same time, which are usually in sequential expiry or maturity. So here we have, which I believe at the time was Cal+2 to Cal+5. These trades are usually registered at a flat average price, though not always. And what we try to show here is the initial margin in percentage of notional value of the trade. On average, in Spain, the long-term hedges we have seen, I would say pre-September this year, have been 3 to 7% in terms of notional value, but can be very dependent on recent volatility in the respective contracts and also the market as a whole. And I'm sure we'll talk about, for example, the recent volatility in power markets in a few minutes. So for the second example here, we see a more recent deal. Actually, it was the first deal in our new expiries in Spain. So these were in Cal+7 and Cal+8, so 7 and 8 years ahead. And as we can see, the initial margin value was significantly higher. And this represents two key factors. First, that it is, of course, a long-term trade in relatively illiquid contracts. And that, as I'm sure many of you listening are aware of, we had, of course, some recent market shocks due to the gas demand crisis, and also the market intervention which took place in Spain, which also created some uncertainty and volatility in the Spanish market in particular. However, even with all of that volatility in the market, the fact that this deal still took place shows that our clients place value and trust in trading on exchange and benefiting from the risk management framework the clearinghouse can provide. So just to wrap up, what are really the key benefits of trading on exchange and using derivatives for PPA risk management. First and foremost, price transparency. As I mentioned, our markets provide reliable price references, not only, of course, in the new 10-year contracts, but across Europe. And project developers and buyers of PPAs can assess their valuations against the wholesale market prices. When using derivatives products for hedging, this, of course, is primarily for price risk management, where you are managing the future risk of price capture in your renewable energy assets. And this, of course, reduces the overall risk exposure for one of the most significant risk factors in a portfolio. Also, when you trade on exchange, as I've mentioned a few times now, your counterparty risk is managed by the clearinghouse. And this becomes significantly more important when you are trading on the longer term and have a very long-term position that is exposed to another counterparty. Whereas here, the clearinghouse will guarantee that position and that execution. So finally, and what we are most excited about and where we hope to see more growth in the future is the fact that by offering this opportunity for offloading the risk onto the clearinghouse, this frees up more internal risk capacity in our clients and in market participants to hopefully take on even more PPAs and facilitate the growth of more renewable energy assets in Europe. So that is it for me, and I am now very happy to pass on to Arne and hear about his views from the market side and from the perspective of a renewable energy developer.
Thank you, Viviana. I hope I'm now online, so to speak. Thank you, Viviana. I think you've covered a lot of the topics that I'm also going to talk about today. I was also asked to very briefly mention who I am and what I do. My name is Arne Weber. I'm heading up the trading and origination department here in Aquila Capital. And hence, I obviously take a vested interest in renewable energy, in forward markets, in PPA transactions, and all the trading that's happening around it. And effectively, I'll touch on a few topics that Viviana already mentioned, maybe add a few extra comments, and then I think the more exciting part, that's why I'm also going to keep it relatively short, the question from your end and hopefully a lively discussion. So let me try and share my screen. This is the exciting part where I can only hope that technology works, which I think it does. Hopefully this is now in full screen mode, so there you go. We'll be talking about PPAs and long-term futures contracts. That's not a huge surprise. And actually, the first picture or slide I want to show is very consistent with what Viviana has already shown us in one of her slides earlier on. For me, the whole mix of, let's say, getting a project over the line and getting a project developed it's a triangle, or like you see here, maybe it's like adding an extra corner by adding wholesale markets. But effectively, what does a project require? It first of all requires a generation asset. So someone needs to go ahead and buy an asset. That asset you buy with euros, with money, obviously, and that gives you the capacity to generate electrical power. And being a physicist by training, I love to be quite rigid about my units here. So ultimately, what you buy here is an option. It's megawatts, it's generation capacity. It's not yet energy. So it's just the capacity, the capability to generate energy. To build an asset, to buy the land, secure the building permits and all the rest of it, you obviously need money, and that money that flows from the project to the generation asset in the bottom left corner, that ultimately comes from financing facilities of some shape or form. This can be banks involved, this can be venture capital, and of course those guys want to see a return for what for the money they give you. So there are also costs attached. So ultimately, again, money flowing back from the project back to the financing facilities, to the investors ultimately. So that's kind of the left-hand side of the business, and I'm not so active on this, but it's definitely a very big part of the Aquila business. It's dare to say we've mastered this one, to have all the vehicles at hand, and all the ways and means of setting up projects is really for us the bread and butter business. And an interesting bit that over the years I would say has been added, not only for Aquila but actually for the markets, I would say, is the question of how do we get paid for now the energy we produce. Again, before we were talking about megawatts, the generation capacity. On the right hand side of this chart, you now see megawatt hours that get remunerated at a certain price, and there are various ways and means of doing this. One way is to have power purchase agreements in place where you effectively sell your power to an off-taker, which can be an industrial or utility or whoever wants to buy the energy. And that can happen, like I said, in any shape or form, actually. Fixed price, floating price, you can come up with collars, floors, you name it, whatever works for your project and your financing in the end of the day. And there's that's like the PPA part. And when people speak of the PPA part, they sometimes also refer to that as the hedged part. And another term that is customarily used is the merchant part. So projects often have a bit of exposure left open to spot markets, to intraday markets, to imbalance markets, maybe also to futures markets, depending on how you manage that merchant risk. And it's a bit semantics, really, what you want to call, what name you want to give this. Ultimately, you can also put it all into one big PPA contract, because after all, PPA contracts are OTC. So any sort of structure you can also bake into ultimately the PPA contract. And what needs to be mentioned here, I think that's an important one, the PPA off-takers themselves also directly interact, of course, with wholesale markets if they want to offload risks or hedge their risks. How you split this, how you slice and dice it, is ultimately really down to the risk appetite of the investors, down to the requirements of the financing facilities. And yeah, so there's no right or wrong. There is no predefined way of doing this. You just need to find a solution which works. Now, kind of going back to the perspective of a trader or of a let's say, a markets perspective, how are markets in my mind split? Typically, I like to think about markets in three big stages. One is the origination tenor or illiquid tenor. So anything longer out than 3 years, I would consider illiquid or very long term at least. And we have a forward market, which traditionally reach from 3 years to spot, so till day +1, and then spot markets covering anything shorter than day ahead. And with a bit of substructure even added here, long-term and short-term forwards, and we have the day ahead and the within day in the spot markets. Now, I guess it's clear, the title of the seminar, of the webinar, already gives it away. We now have very long-dated futures contracts, so that's probably worth being revisited. My comment here on illiquid or not forward or futures is longer than 3 years. That's not quite true anymore. I think it's still fair to say that liquidity is very different depending on whether you look at the 3 year or the longer than 3 year tenor. Why is that split somehow relevant? Not only because of liquidity considerations, but also because of the way these markets function. And actually many trading entities and trading teams also split the responsibilities along this, let's say, trading tenor axis. It's mainly because the drivers, the underlyings, the fundamentals of these markets are very different. If we start at the very short-term tenor, I mean, here we're very much driven by, I would say, market dynamics themselves. There's a lot of liquidity. It's almost hyper-liquid markets nowadays. In markets like Germany, there's one hell of a lot of trading happening, and it's very dynamic. We are driven by short-term events like power plant outages, short-term weather events, rainfall, cloudiness. All these things instantly have an impact on these markets, and they're instantly reflected also in the prices we see. And they're also very much exposed to local regulation, because effectively within their markets, well, they have a different regulation depending on where you are to begin with, but then also things like imbalance regimes and stuff like that are different depending on which country you're in, which region you're in. Easy example, in some countries you're allowed to go long and short against the grid, in other countries you're not allowed to do that, and that already makes a big difference in how traders behave. Market access within their markets, mostly automated through auctions, continuous trading. We have route to market platforms. There's a whole lot of ways of entering these markets, and I'll have their pros and cons. I don't want to go into the details of that in today's session. Going to the forward markets, I think here obviously we're driven more by longer term events, more by fundamentals of the markets. And the split that is often done there is to go from 1 month ahead to day ahead, and anything that's longer. And the reason for that is that effectively weather forecasts become more and more accurate starting months ahead, and then short-term trading very much is driven also by weather events and weather prognosis, whereas the very long-term stuff, you could say it's probably more than a very long-term weather trading that is happening there, even extending out into climatology effects. I mean, what do you mean by climatology? I would say the difference between weather and climatology is that climatology is a very long-term fundamental structural changes. So, for example, the impact of global warming on the efficiency of wind or solar. That's the kind of stuff that I would consider very long-term. And that very long-term stuff is, of course, also reflected in the trading and the transactions that we see in the origination type tenor, which is longer than 3 years. And again, the session here is mostly about the 10 years futures contract. And I think that's an interesting one now. So I would say historically, there was quite a clear distinction between, are we now in a very illiquid trading or are we in the forward markets? And now these two markets are actually melting together, and they're becoming to some degree one. And that is, of course, very exciting if you're active in a PPA market. What are we dealing with in terms of risks in a PPA? And I think, again, that's important to think about when you think about also the hedging requirements and the stuff you want to do with your positions effectively. For me, the most prominent risk components are base price risk, shape risk, imbalance risk, volume risk, and credit risk. Base price risk is effectively the overall price levels that we're dealing with. So very simply speaking, the value of the base load contract. Shape describes the cost or the risk that is attached to a renewable asset not generating a base load profile, but having a different level of generation in every hour. You're driven by wind, you're driven by solar, that's your fuel, and that's what triggers and drives your generation and your shape. You're effectively a price taker here, and that is then a risk you need to manage. And it's also sensitive, of course, to the generation stack. If there are a lot of players that have the same generation shape and profile like your assets, you're likely to produce in cheaper hours. That comes with cost. People talk about cannibalization there. This is exactly what this component is supposed to describe. Imbalance risk is an interesting one because it's very short-term risk. It's the short-term prognosis errors that ultimately result in imbalance positions, or the requirement to trade very short-term in intraday markets. And in my opinion, that's very much regulation driven, because I mentioned this earlier, in some markets you're allowed to go short or long against the grid, in others you can't. And that definitely requires different types of orders being placed. If you have to be balanced, you will end up at some point in time with placing market orders just to make sure you've got your volumes covered. And so I think regulation plays a crucial role here. Volume risks are in a way the very long-term imbalance risk. So I mean, if it's ultimately the risk you take if your assets, for example, underperform or overperform. So you place a hedge based on a certain assumption on what your volumes are going to be. And if you totally deviate with your long-term prognosis on the volumes, you end up over or under hedged. And being over or under hedged is a position that is ultimately a risk position. You are long or short against your hedges, and that's not a position you intentionally entered. So this is a risk ultimately that you need to manage. And here we are also exposed to climatology effects. Asset performance is in a way an equivalent in terms of how it reflects on your volume. Easy example: you design an asset, you think a wind curve translate a 1 meter of wind speed translates into 1 megawatt hour of energy being produced, and once you've built the asset, you realize, well, it's not quite 1 megawatt hour, it's actually only 0.9 megawatt hours, then you're all of a sudden missing energy. Of course, it also has an impact on your overall business case, but it definitely means you also are overhedged in that particular case. Credit risk, I think, is very clearly, it's probably the in a way the easiest and the most complicated risk to deal with. It's very clear. You assess the credit worthiness of a PPA off-taker, of your counterparty, but you have to do that also in light of market conditions, and that's where all these margining mechanisms kick in, and where they play a crucial role to effectively help manage these risks. There are many other risks in a PPA, legal risks, operational risks. I'm not going to go into them. They're difficult to quantify at times. I think like legal risk, clearly that's a difficult one to put a price tag on, but they're very important nonetheless when you structure a PPA contract. And just to wrap things up, for me, the big transition we're currently in is one, and it's probably enough to just go through the headlines in order for me not to take up too much time. We come from a world of feed-in tariff, where effectively your base risk was somehow managed by a subsidy scheme. You either got a guaranteed price or a price index. Your shape risk is often taken care of by means of a market factor, like in German direct marketing, for example, that covers at least the majority of your shape risk, and you end up with a residual risk of your particular assets production versus the market factor or the market risk, a market shape that is being assumed. Imbalance risks, well, again, depending on your subsidy scheme, sometimes even that is taken care of, and yeah, volume risk is actually customarily accepted by the projects or by the project developers, and as it stayed back, credit risk is not too much of a concern. Bilateral PPAs somehow have an, I would say, different trade-off of risks. First of all, nothing's predefined, everything's allowed because these are bilateral transactions. So in a way, you could say any risk component that I've touched upon here can be addressed to perfection in a PPA. It's then a question of price tags and also the willingness of the counterparties involved of transferring these risks or accepting these risks. And like I said, at the end of the day, in my line of thinking, that always means if someone's not very happy to have risk, he probably quotes you a very bad price for it. Counterparty risk is probably the one that is most worthwhile mentioning here. It is OTC transactions we're dealing with. So you are facing counterparty risk, and that's probably the biggest difference ultimately to a feed-in tariff. So you have a lot of flexibility in how you negotiate these things, and you are dealing with a counterparty that is not a state. So first assumption would be that the counterparty risk is somehow more prominent. Now, with these exchange transactions coming in, and it is an EX webinar, so I shouldn't forget to mention this. This is clearly extending the scope of PPA of futures markets. So in principle, now all of a sudden we have products that are time congruent with the typical project financing tenor, or the initial financing tenor, I should say. So if companies are looking for 15-year PPAs or 10-year PPAs, now you have a tool provided by EX, and I dare to mention it, also other exchanges that allow you to trade longer term futures contracts. And this comes with a bit of a trade-off. I mean, you're not as flexible anymore with how you structure these things. Clearly, it's not bilateral. These are standardized contracts. You can only proxy hedge certain risks. For example, a shape risk, you can probably address that by means of peak and off-peak products, peak and base products, but there's not going to be the perfect hedge for you. There are wind futures and similar products out there that address the problem, I would say, of wind shape. And I would say there's then the trade-off, how much liquidity can you find for these products? Yeah. Imbalance risk is a risk that typically sits with portfolio managers then, and it's difficult to hedge that very long term. And the same holds true for volume risk. Credit risk, on the other hand, we are dealing with an exchange here. We are dealing with margined transactions. So effectively, the exchange takes that problem off your hands, which is very nice. And I would say what is very, very important to take away here, and it's probably the most important statement overall, there is no one fits all solution. The perfect structure, the perfect setup that works for your project, for your investment, it needs to be tailored to the needs of the parties involved. And that's, I dare to say this here, us at Aquila, I would say we pride ourselves in being very flexible here, trying to find the right solutions for our investors, trying to find the solutions that actually work and make sense. And there is no such thing as the right PPA, the right way of doing things. I'm not going to say 10-year PPAs are bad or good. They can be good, they can be bad. It really depends on what you want to achieve with them, and maybe even a mix of it all is ultimately the goal you seek. But I think I should leave it at that, and rather than open the discussion and take your questions. So thank you very much.
Great, thank you so much, Arne. That was really, really good. I think you did credit to your academic background, gave us a lot of information there, and all of it was super interesting. So thank you so much. So we kind of heard a lot about the broad principles and dynamics of PPAs and risk management, but taking it back to the present day and the situation we are all currently in. How do you see the recent volatile price movements, and how have they impacted PPAs, especially even, of course, with market interventions and all of these really extraordinary events that are happening now? So yeah, it'd be great to hear your views on how that's impacting the market.
I would say the current market situation is, of course, rather extreme. And having been in the field for a few years and having seen different market environments, I must say that what is happening right now is extraordinary. I mean, the absolute price levels are extreme. The level of volatility that we see is extreme. We see that even long-term futures contracts have substantial within-day moves. All that is in a way exciting. It's also in a way worrying, depending on what side of the trade you sit on. I would say what it definitely shows is that we have very extreme volatility, and there are risks resulting in that. And these risks need to be, I would say, adequately managed. And for me, what I think this really triggered is for many people, many players in the market to start thinking about, well, you know, where in the past maybe you said it's great to source short-term power in the spot markets and just be done with that and then secure your supply that way. It actually may trigger thought processes, and that's at least what I hear and observe in the market. People are starting to think about now, okay, look, if you're facing these significant risks and these significant volatilities, maybe this is the point in time where we start also thinking about how we manage this more efficiently, how we maybe take out a few risks on the power side of the business, and that way give ourselves the possibility to focus more on, I would say, the core business, and whatever that core business is. If you're an industrial producer of goods, whatever they are, and power is really a waste to means for you, then maybe you're very happy to now go in there and think about sourcing power in a different way. And I think that's really the stuff that is now coming in motion. In my experience, that typically takes a bit of time for people to realize. Such a crisis, if you want to call it that, I would say such a volatile market as we have it right now, clearly helps to get people thinking in the right way. And then it's really down to, I would say, the players in the market to find the right solution. And of course, this is ultimately what we're here for in Aquila, also to help them find these solutions with our clients.
Very good. Thanks. And I know that we've touched a bit on this already, but maybe, of course, as we have the topic of the future of renewable energy risk management, if we're looking forward a bit more, how can power derivatives and exchange traded products help to improve revenue strategies for PPAs and actually help evolve PPAs? So yeah, where do you see this going?
I mean, for me, it's, well, any let's say addition to the toolbox of hedging instruments that is brought to the table is good. It's really it's very useful to see these, let's say, evolutions also in the market. I mean, again, I mentioned this very early on. We can structure things in a different way, and just to have more tools and more ways and means of addressing problems, of addressing risk. And I wouldn't even call it problems, right? I mean, you're effectively dealing with different risk appetites, but different investors, and every project has its own needs. And what we ultimately need to do is we need to structure something that works for our investors and or same likewise for the off-takers. And the interesting bit is that if we now have a futures contract that is time congruent with let's say the typical financing tenor, it on the one hand adds an extra tool. I would say the interesting bit about that tool is that we're going from transactions which are OTC or fully OTC, that's the standard PPA, to now there's an instrument that is cleared, and that having cleared transactions is of course very attractive from a credit risk perspective. You don't have to worry so much about putting up collaterals and whatever guarantees that you may need in order to get a PPA over the line. But of course, these clear transactions, it's two-sided sword also, right? I mean, right now we see that markets are rallying. You sit on a physical position, and the market is going through the roof. When if you hedge directly with a futures contract in exchange, you're facing significant margin calls, and that's also something we see in the market right now, and that's putting stress on your cash requirements. So again, there's no right and wrong answer. It's just great to see that there's another instrument being added, and I think using that wisely and maybe even a mix of it is the right solution. Is what I find very interesting, and that's actually where I also see the market evolving to. It's not going to be like I would say 10 years ago when you just went ahead and you wanted to build an asset, you just went and got yourself the feed-in tariff, and that was it, right? I mean, it was very easy, very linear process, very at least from the financing perspective, I would say clear what to do. Now there are way more ways and means of doing this, and that's also how I see the market evolving. I mean, people will just make use of the tools at hand and the options you have available, and there will be way more creative structures, and ultimately that will just add to the mix of things we can do. I just think it's great that it's market-based mechanisms that are being introduced here, so that will allow for price signals. We will have very clear signals on what works and what doesn't work, and I think that's actually very beneficial for everyone involved.
Perfect. Yeah, I fully agree. I mean, there are a few things there that ring true to us at the exchange as well. Obviously, market-based solutions are what we strive for, what we always promote, and also yes, it is more complex to deal with futures products and to deal with margining, to set up the processes required, and then evaluate that on the basis of this toolbox. And we do see as well that this is a big learning curve for a lot of renewable energy developers in particular. So I'd be curious to hear from your experience. Obviously you were at RWE for many years and you moved to Aquila. How have you had to experience this learning curve, and what would you also recommend to renewable energy players that they do once they are starting to look into entering into the wholesale markets?
I guess the easy answer is, of course, to find yourself a partner that is very competent and great, and then why don't you give us a call? We're very happy to help. That's the easy answer. But of course, in all seriousness, it is a complex field. It makes the topic of margining is one that, especially for physical assets, makes life much harder. I mean, I mentioned this earlier. Effectively, you find yourself in a position where you're long the physical asset and you go short the futures contract in the exchange. If you want to de-risk this thing, this is something that you then need to finance with effectively cash in the bank or collateral. You somehow need to have money to feed the margin calls. And it's true, it very much depends. I would say it's a very project specific question how you address this and how you do this. It depends on your capital structure, your underlying financing of the projects, also what works for the banks. So I guess, again, there's no clear this is how you do it answer, but it's really one where you need to sit down with all the players involved. And I started off by saying you have the investors, you have the project developers sitting right in the middle. You need to secure the lands and all the rest of it. So it's a very complex, let's say, mix of things you need to take into account, and there's no, I don't have a, let's say, off the cuff on this is how you do it. I think the devil's in the detail on these things, and the best thing to do is really to this is in all seriousness partner up with someone who's done it before, who knows how to do it, and get these deals over the line, because it is complicated. It's not a trivial task to achieve this, and yeah, I mean it's ultimately one of these things that we deal with and also find creative solutions for.
Perfect. Yeah, I mean, we also really, I think for that reason, also, promote or point towards intermediaries as useful partners, and see that role increasing in the future. Also aggregators we hear a lot about, but aggregators with experience in wholesale markets are also really beneficial. So going back to also the product side, so I think you mentioned wind power futures, for example, in your slides, and there's also a question on it in the Q&A. EEX did have a wind power future product, so did another exchange. Unfortunately, I think we were all a bit too early to that game, but it's coming up again. So that, I think you see already a gap for potential renewable energy risk management products. So maybe you can talk a bit about that, and also if you see any other gaps or more potential.
No, absolutely, and I think it's an interesting one, because I mean, I would start by saying it's in a way clearly a wind futures contract is the perfect or nearly perfect hedging instrument for a wind farm. Why is that? Obviously, that thing somehow reflects the shape of your generation. It's a bit like the market index or the market price index. That applies in German direct marketing. So you somehow most of the basis risk is taken away by these futures contracts, and that's super useful. The problem, of course, is I mean it's probably a bit of a cheeky comment. Why is there no €1.99 coin? Why is there no €1.97 coin? Because it would be kind of cumbersome to deal with that. It would be very useful if you want to buy a product that's $1.99, but it's not going to help you much with anything else. And I think this is a bit the problem we are facing also with these, I would say, slightly tailor-made wholesale traded products. They are increasingly niche. I mean, the more you divide and slice and dice the product spectrum, the more liquidity is also separated. And I would say it's the huge success story of EEX that you manage to establish a futures contract that is super liquid. I mean, if I look at German futures contracts in power, the first 3 years for sure, incredible liquidity, huge amount of open interest, a lot of trading happening. So if you want to hedge a position, if you want to trade a position in these markets, you're absolutely guaranteed you'll find someone who quotes you a decent spread, and you find someone to trade with at what I would consider a fair market price. It's definitely a price that is very liquid and very transparent. The worry I always have, let's say, by introducing new contracts, new products, that you kill liquidity in the process. Like if you then end up with a product that is perfect to hedge one asset and one asset only, you're never going to find someone to liquidly trade that with you. That is, I would say, the clear downside of this. On the other hand, of course, we need to keep an eye on what is let's say, what is globally or on a bigger level, what is required by our market participants in order to hedge their risks. And I mean, ultimately the market will decide what works and what doesn't work. We saw that the first attempts with wind futures didn't work. We also see that trading houses, traders are very happy to accept, let's say, a certain level of I can say proxy hedges or proxiness, whatever you want to call that. I mean, a good example is probably if you look at Dutch power. I mean, it's often hedged, proxy hedged in Germany, just because at least you have liquidity there. And then it's, I guess, ultimately a judgment call by the respective portfolio manager and traders what they feel more comfortable with. A bit less liquidity and having the perfect product, or super liquid and the not so perfect hedge, or the not so perfect a trading product. And I think we shouldn't stop trying with these new or more innovative products. I think it's effectively where the exchange really has to play a crucial role. Speak to your market participants, speak to your members, make sure you tailor products where there's significant interest. But we also know that even if a trader tells you, yeah, I'm in principle interested, it's still different whether he ultimately wants to trade on it. So I think we have to accept a bit of failure in these processes. I don't think that's a bad thing. And then we have to consciously decide on what are the products that we want to introduce. And I guess that's a process where we jointly, the traders, the market participants, the project financiers, all these parties involved have to sit at the table effectively with the exchange. And I would say I wouldn't even limit it only to the exchange members, but also all the other guys that are left and right.
Yeah, I mean, that actually perfectly articulates exactly the process that we do go through when we build a new product, but also the challenges in defining the scope of a new risk management product. So thanks very much for that. And we are still committed to developing these new products. And I think some kind of technology specific product, but maybe more represented on price, is an answer. For example, the old wind futures were based on a load factor and you weren't actually trading a price. And so I think that'll be crucial going forward, maybe to represent the capture price, as it were, of a technology in a given market area. But to do that, we also need to have a transparent underlying index, something that represents the spot value. And so this is something that we're already in very, very, very early stages. But again, yes, it will take a lot of coordination throughout the industry to make sure the design is right. But also, I think another often overlooked point is that that product must also go through your entire trading operation from front office to back office and be integrated into, for example, the ETRMs and all of the different elements on the value chain of trading. And sometimes that's also what trips up the success of these products, as it were. So we are aware of it, and it's something that we are committed to, and hopefully we'll see more of that coming in the future. And speaking of also what's coming next, and where do you see most liquid PPA markets in Europe right now, and maybe which ones are poised for further growth? For example, if you were to give a little wish list to us of which products we should extend to 10 years in, or which markets, what would that be?
I think it's an excellent question, right? I mean, effectively, we're driven by a few factors when it comes to developing projects, and I'm to be very clear, I mean, we have people in the company who are much better equipped at telling you what the perfect locations are, what the perfect sites are. This is exactly what our teams are working on, the investment management teams, and they absolutely go through these cases, I would say region by region, asset class by asset class, and really pick or try to pick the gold nuggets there to find the most promising spots. But what's very clear is, I mean, in markets where there is a feed-in tariff and totally dominates the market, it's difficult to come up with a functioning PPA market, and then maybe as a second step, a liquid futures market. There's just no obvious need, at least not from the renewable energy side of things. I mean, maybe there is a need from the industrial side where people want to log in long-term positions on futures markets. But that being said, I think you can kind of do the maths and ask yourself where are there juicy subsidies and where are there not so many subsidies, but still good sites to build assets. And I would say if you just look at Southern Europe, there are great opportunities. Spain, Iberian Peninsula. That's very interesting. Traditionally, of course, even the Nordics, there's a lot happening. A lot of hydro, of course, there. So that's a different, I would say, slightly a different, I would say, customer base and project base altogether. But also there we have, I would say, the potential, and these markets are quite well developed. There are also big exchanges there, and where there's a lot of lively trading. So I think there's definitely stuff happening. And I think even globally, right? I mean, there's interesting things happening worldwide, and that's maybe again a bit of an advert from the Aquila side. That's why we're also active globally. That's because we see these opportunities not only in Europe but worldwide.
Perfect. Yeah. No, that's definitely true. To put it into the global context, it is a kind of a trend that's happening around the world. You know, on the EX side, as our advert, we obviously had our successful entry into Japanese power, which is actually, you know, a product representing Japanese generation, but listed on a European exchange, and that's actually gone very well for us. And we hope that that also translates into some risk management, perhaps for Japanese renewables. So really exciting times, lots to look forward to. And I don't see any new questions in the Q&A chat. I think we've already addressed them during our discussion. So I believe we will wrap it up here. And of course, you know, if anyone wants to reach out to us on LinkedIn, please do so. The slides and the recording of the webinar will also be published. And to catch that link, just follow EEX on LinkedIn or myself or Arne, and we'll be sure to publish all of that. And I can only then say thank you so much to Arne for joining us today. It's always really great to chat with you and hear your views based on your wealth of experience in this industry and in this market. So it's been really fascinating. So thank you very much.
Thank you for having me. An absolute pleasure. Thank you.
Great. Then wishing you all a good day, everyone. Thanks for joining, and hope to see you all again soon.
Thank you. Bye.